Ladies and gentlemen, welcome to the greatest show on earth that's hosted by two guys on StreamYard remotely on Friday afternoons at 3 p.m., ostensibly about finance. That's us.
Wearing pirate sweaters.
Wearing pirate sweaters.
Yeah.
The more we qualify and conditional, the more it's true.
Exactly.
Well, Jason, let's do the usual intro. Let's start by saying this is Jason Buck. I'm holding up my wrong hand, pointing the wrong direction. The handsome man on the other side of the mic from me is Jason Buck. I'm his co-host, Corey Hoffstein. This is the Pirates of Finance, where we're going to talk all things markets, entrepreneurship, finance, whatever comes to mind. Honestly, who knows where we'll go? But we should really stress that this is not financial advice. Do not take it as financial advice. It's just two guys chatting on a Friday afternoon after a long week. Just because you might be listening to it later on a Monday, that also does not make it financial advice. This is financial advice at no times. Seek help from a professional if you are looking for advice. Last thing I will say is, look, if you enjoy the show, if you've been listening for a while, we would greatly appreciate if you'd like, rate, subscribe, review, whatever you can do. It means a ton to us. If you do, we hope you enjoy. Even if you don't, we hope you enjoy the show, just not as much as those who do like, rate, subscribe. Without that, Jason, I want to say, by the way, I take a lot of shit on this show for how my mic performs. I pop constantly every week, like it just goes in and out popcorning. Did you or did you not have an hour-long Zoom call with me yesterday where there was zero popcorning?
I can confirm there was zero popcorning yesterday, but I want to say, while you were in the middle of that rant, your internet did go out for a second. So I wouldn't be running your victory lap just yet. Now I was thinking, when you're saying like and subscribe, I was like, yeah, we need more of those advertising dollars so Corey can get a better mic, we get some better internet connections, and maybe can get some paint for those pink walls behind him.
I think I don't know what I think my setup is cursed, honestly. When it comes to live podcasting, it's like I finally think I figured out the popping, and my internet's been shit all day. Yeah, this is what I get. I've cursed us, tempted the IT gods. So look, before we go into new topics, I actually want to revert back to a topic from last week because they're hot off the press today, like as of an hour ago. So last week we talked all about BREIT and the University of California's investment into the Blackstone REIT. They're absurd. Are you laughing because I dropped? I can't.
No. I'm so sorry to interrupt you, and I try not to look at the comments. But Menahem said Corey got a slick haircut. Maybe the fund isn't doing that good. Because remember your comment about
it's early in the year,
not shaving or getting haircuts. Like that was a hell of a callback by Menahem.
I'm back on the capital raising road. No,
sorry, I didn't mean to derail the REIT.
We'll derail so I can explain. I think, as I've mentioned, I have a kid due in 2 months. Yeah, 2 months. And I have a conference. You and I are doing some conferences in Miami in a month. So I like to get a haircut leading into conferences so that the hair grows in a little more naturally. But I'm also trying to speed run different haircuts and facial profiles because I got a little soul patch going on today because I'm thinking about those first pictures that are going to happen in the hospital that live forever. And I just want to make sure that whatever I choose to look like, I'm ready to live with that forever. So I'm trying all sorts of different stuff. I don't need you to comment on that. Okay, back to the original where I was going before we got distracted. So,
there's so many things in there.
I know. I'm not even going to let you talk. I'm just going to keep going. I'm going to bully through so that you can't tear me down. I'm on a positivity swing. Look, last week we talked about the University of California making this big cash injection into the Blackstone fund that was ostensibly having issues with redemptions, and having an illiquid asset class and having all sorts of redemptions is a recipe for disaster. They took in all this money for some guaranteed rates of return to the University of California. Well, as of almost an hour or two ago, it was announced that unions representing 110,000 University of California workers are demanding that the pension system divest their holdings from Blackstone, including the recent $4 billion investment in the real estate trust. I'm reading from Bloomberg here. The groups are contending that the relationship with the private equity firm will worsen the housing shortage for students and employees, according to a letter dated on Friday. The University of California's investment office struck a deal earlier this month to inject $4 billion into the Blackstone Real Estate Income Trust. Quote, the University of California's current housing investment strategy, combined with bolstering Blackstone's B-REIT, will only further deepen a hostile housing market for millions across California, union leaders said in a letter to Jagdeep Bachar, I believe is his name, chief investment officer of the university's $152 billion pension system. Thousands of the university's graduate students and workers went on a month-long strike last year demanding pay increases because of the high cost of living in California. So really fascinating, in my opinion, that the union that the pension is supposedly working for, or at least many of the pension participants, is saying, not only do we want you to get that money back, we want you to divest any investments you have, right? Think about if this was indeed a liquidity-driven requirement for Blackstone, that they took this money in because they're trying to meet redemptions. And not only is the university now going to say, we want the money back, but also we want we're going to do a redemption. That could be incredibly painful for Blackstone. But what an interesting political situation.
Man, I don't know. So actually, it was great. Is actually I have a similar topic that I can tie into this. Is I think we saw this before. It's understandable, I guess, with university endowments these days, and we saw this even prior to the ESG movement, where you had students protesting of where their endowment was placing money. Now, typically, it's usually West Coast universities, et cetera, or East Coast, kind of the coastal universities. But it begs an interesting question, though. Like, can you strike, or can students protest, and can you determine where you allocate those endowment funds that you have relationships, whether it's a union or a university endowment? And then the question is like, who's looking into it, right? Like, if you want to take out the sin stocks and everything, and you want to go ESG, or you want to be out of this B-REIT, one, you're like you're figuring out the consequences of your actions, and is that really going to lead to a housing shortage? And then two, like everything else, like when you take out energy stocks or whatever, is like, what are the cascade of consequences? And then what else are you actually investing in? But what I want to kind of tie it in a little bit is like, lately this week I heard from my non-finance like family and friends, or even just around town, is like, did you like? Hopefully you haven't read the headlines. Like, Elon Musk loses the most amount of money ever. Have you seen or heard people talking about this?
I did see that headline pass in my, I don't know, it must have been on Twitter or something this week.
Okay, and by the way, there's so many things on this. I'm gonna tie it back into what you brought up. It's like, okay, as always, like whenever a hurricane goes through, they're like, it caused the most amount of like this year it was $10 billion worth of damage. It's the most in history. It's like, yeah, because the notional amount of housing stock keeps going up, every time. Like, and so Elon Musk loses the most in history, yeah, because he's the richest person in history, right? Like, and my favorite is like, so I looked up the numbers. He lost 182 million. You know what he's still worth?
Billions and billions and billions.
146 billion.
Yeah.
So, but yeah. my point
First of all, he must have lost more than that just in Tesla stock alone on paper.
Right. Well, and things we've been talking about on the show is like, it's round tripping from pre-COVID, basically, right? Like it's just going back to the mean. But at the same time, what I found with people, there's an underlying glee of when people say that, and I've just kind of found that a little bit fascinating to me. Is like, one, why do you care? And then two, like the glee they get from it. And I'm like, he's still worth like so much more than everybody in the town I'm in combined. Like, what are we talking about?
Well, I'll tie it to another market technicals point is, and I know you've seen this one, which is most dollar notional traded in S&P options.
Yeah.
Right.
Like,
and you go, well, yeah, if the S&P is like worth 4 times more than where it was, 10 years ago, then of course the notional traded, even if the number of contracts stayed the same, the notional traded is going to be 4 times more. Like, you need to appropriately correct the divisor, right? It's units, not dollars. So in Musk, it's like, who cares how many dollars he lost? What percent of his net worth did he lose?
Right. Well, and then it was, roughly like 50% or more, like 60%. But once again, who cares? Like, and then, but why I bring it up though too, and bringing it back to the REIT is, Jared Dillian was writing about the Daily Dirt app. He was talking about the Musk phenomenon in almost a different way. It's like when he was saying when he was on Wall Street, it was all about making money and morals and ethics be damned, like just make some money. And he was saying how the very people that rally against like ESG for being stupid and just philosophically bankrupt are the same people that will short Tesla and just pound the table for morals and ethics with Tesla. And I'm not on either side of that camp. I'm not saying anything on either side of that camp. I'm just saying what he was pointing out is interesting is like, it's not about making money anymore. It's about showing your morals and ethics through your trading philosophy. And I think that's a really interesting twist or turn. And this is obviously tying back to what you brought up, because we were talking about privately, and I don't know if I brought up on the show before, there was that Life After Lifestyle essay and some of the other podcasts I've sent you recently. And it just keeps making me wonder, is like, have we almost switched to an era where it's not about just making money, right? It really is about expressing morals and ethics. And, you know, whether that's through media, you know, politics, news, and now investing, is like going back to what you're saying, is like, they might not make as much money as an endowment or a university because of ethical constraints or concerns.
So there's two things I want to say. First, I want to rewind to something you said earlier, which is one of my pet peeves, actually, but I have zero justification for it being a pet peeve. And it's when someone says begs the question, because that's, yeah, nothing ever begs the question. It's a rhetorical device. That's not, it doesn't
I
mean
don't even know I said it. Yeah.
Raises the question. And by the way, I'm the real asshole here, because this is one of those cases where so many people say begs the question that the definition of begs the question has now changed to mean raise the question.
Like literally, yeah.
And I have no reason to be a stickler here. It's not like I was in debate in high school or anything, and like the rhetorical use of begs the question means something to me. But it just, whenever I hear someone say it, I'm like, oh, it really gets me. And it's the dumbest thing for it to get me. To your more important point about ethical investing, you know, I can step back objectively and say, what a ridiculous concept. Unless you're willing to give up returns. Like if everyone is agreeing on what ethics and morals are and everyone's selling down, like what actual impact is that going to have on companies? Well, maybe it changes their cost of capital, being able to issue equity. Does that have a play-through impact? I have no idea. Honestly, I don't think the numbers have really, we've been able to do the studies yet. But what I would surmise on the other side is that if everyone sells it down, it should be a stock that should go on to outperform, because everyone's expressing a view that is not economically related. So you would need to see, for it to not have a impact on net returns, you would need to see that the increase of the cost of capital at least offsets the increase in the expected return from the stock for being undervalued. That said, so I can sort of like wear my objective quant thinking hat about this a little bit.
Does it beg the question?
It might. It might.
Or raises the question.
Well, it might raise a question, not beg the question. But let me take a turn and just sort of change the direction, which is we've always had morals and ethics in business, right? We have always said, like, everyone has a line in the sand about what sort of business they are and are not willing to do. I think you and I both agree that if we were to act immorally, at least in the short term, we could probably raise a lot more capital than we could acting morally. And so we already acknowledge we're willing to give up, I'm using air quotes here for people who are listening, give up returns by acting morally. Maybe in the long term, you can say acting immorally will send you to jail. So it's like your ultimate tail risk is there. But we accept moral action and encourage moral action in business. Why is it necessarily different in investing? If you think a business is acting amorally, like, why should you just passively own it?
Well, you're who creates the standards for morals and or amoral within investing and how you run a business?
Well, it's the same.
By the way,
the standards and morals for investing, for business in general, right? It changes over time.
Right. Well, that's part of it, right? So, by the way, whenever it says business, I think of Billy Madison, business ethics. It's like that Billy Madison. But no, that's the problem. Is moral turpitude? It's a nebulous idea that is actually incumbent on a subjective perception. right? Like we do things that don't break the law because there's a law written, and even that's interpretable by people, right? And so the idea was, again, so who's going to determine, you say you run your business morally and ethically, but somebody else might feel that you don't for variable reasons. And so this goes back to the California endowment. Who's determining what's the moral and ethical, like which companies are run morally and ethically?
Well, and it's an interesting dilemma of what does the fiduciary standards say about investing for on behalf of other people, right? If they explicitly ask you to invest a certain way that you think is actually worse for their returns, but is in line with their ethical behavior, right? You would certainly think you would run across this with religious groups and endowments tied to churches or synagogues or something like that, where they might have very strict requirements as to what they can or cannot invest in based upon their religious beliefs. I've never had to deal with that as a fiduciary, but you do wonder, if you believe it's in conflict with what is truly in the best interest of your client, what does best interest mean? Returns? Does it mean best, like what's in their interest from returns constrained by their needs or wants or morals or ethics? We clearly embed morals and ethics in everything, by the way. You have moral and ethical standards for lawyers that can get debarred. You have moral and ethical standards for accountants. You have moral and ethical standards for financial advisors. We've accepted them. They exist within the business world. Now, they might change over time, but every society has their own standards. It does raise another interesting question of, if you have two societies with very different ethical standards or moral standards, how do they act on the same global stage as each other?
Which that's what some of the arguments would be for a multipolar world, like who is technically right? No, because it's still subjectivity. And like you said, what I view as laws, like when you say within our industries or any sort of professional industry, you can get disbarred and all those things. Like, to me, that's a law. That's not really morals or ethics, even though it's not technically a law. Like you said, it's a self-governing body,
We've codified,
right? Which is a
morals
law
and ethics in a law, right?
Yeah, right.
By the way,
And
this is a rabbit hole that's very dangerous for me, because you know so much more about philosophy than I do. That this is just, there is a certain, like, I'm swimming with my swimmies on in the shallow end, and I know you're just beckoning me to the deep end. Like,
you're right. Okay. I was actually thinking about trapping you, but I won't do it. But what is interesting, I actually, tangentially related, is that for everybody that's agnostic these days, or an atheist, they rally so hard to Christianity, God, or any of the Abrahamic religions. It's so funny. Almost all of our laws or our codes of conduct come out of like Christianity in this country. And yet everybody's like, oh no, I'm an atheist, I believe it. It's like everything you do as a person within a community and within trying not to break the law comes out of Christianity, Christianity's doctrines. Like, so it's always interesting to me, is like, oh no, I'm outside of that. It's like, no, you're not. But what I was wanting to bring up with what you're saying is like, it's an interesting thing now. Like, I'm not saying right or wrong or whatever, but it's fascinating to me that, like, you brought it up. What is the responsibility of a fiduciary, right? Historically, it has been to make money for the client. And now, that's what I'm saying, has that Overton window moved, or the zeitgeist has moved to now you adhere to the morals of the client, and kind of P&L or return be damned, that is more about morality than return. And I this is really run around in my head in so many different ways of like, it just feels like that's the world we're moving into.
Yes. Yeah, and I'm not sure I'm here to say that's a good or bad thing. Right? Again, I go back to, we enforce ethical and moral behavior from a societal perspective. Those ethics and morals change over time. Why shouldn't someone express them in their investment view? I don't know. I don't actually have a good answer here. Now, do I think the current way in which it's done, where certain index providers have thousands of different ESG indices that are questionable as to whether they're actually making a material shift from the market benchmark, and then they're charging a lot of money for that data, is that useful? Probably not. But I know a lot of people who take their SRI or ESG driven investment mandate incredibly seriously and do a huge amount of lift trying to get the data to determine and score companies and figure out what lines they do or do not want to draw in the sand, and how they want to express those moral beliefs for their clients. And I actually don't have anything against that, right? Like
I don't
we
either.
let someone be a value investor. We let someone be a momentum investor. Like, why can't they be a moral investor of their own definition?
Fine by me, but I just think it's a shaky pedestal, right? Like how it's turtles all the way. Like how much deeply are you looking into it? Like there's simple things like that are contradictory. Like if you don't want to be in BP because it's a sin stock and oil, but like they're also maybe the largest investor in renewables. And if you love renewables, then what do you do? Like, it's like there's like you
Yeah,
got to
but
really dig
that's
into these things.
again. You say there's like those conflicts. I agree, but let the investor
Yeah.
determine. Right? They'll pick the manager. It's a free market. The manager will say how they will handle that, and let the money flow to the manager that handles it the way the investors want it to be handled. Some managers might say, that's awesome. We want to encourage that. We want more BP and underweight Exxon. I have no idea what Exxon's doing for renewables, by the way, right? Or they might say, you want to know what? It's not enough. There's enough people already investing in that sort of stuff. Some might say, we actually don't want Tesla. All the batteries, mining for nickel, shipping it all over the world is actually worse for the economy than the potential benefit of EV in the long run, right? But let the manager make that decision, express it in the portfolio, and let people choose those managers as they see fit.
Yeah, the problem is like which manager, like we always talk about, is like nobody really does proper due diligence or
Yeah, well,
like
I'm living in a fantasy world right now.
I know, it's fine. I know, but we're talking about it in interesting ways, and like yeah, it's like who's gonna dig into that, and how do you determine like they can have it? To me, it's like selectivism all the way down. It's like everybody's trying to express these moral views through a selectivistic interpretation of like I'm gonna protest this, I want to change this, and I want you to invest in like ESG companies. And it's like, okay, can you define that for me? Okay, now let's go through all the line items of all these companies, and you tell me which one's ESG. But nobody wants to take the time to do that. But everybody wants to look good on a media site.
If you had said to me an hour ago that I'd be on this podcast defending ESG and SRI, and you'd be against it, I would have just been like, absolutely not. But here we are.
It relates here. I'll get us out of this. I was
gonna say permission to change the topic.
Yes, let me get it out of it. And because we never
ESG.
I love our ticker, whatever we call it. Not ticker Chevron. Tape? What do you? Yeah, well, no. What do you call it?
Oh, isn't it a Chevron?
Chevron, right? Yeah.
Anyway, isn't that an oil company?
So I'll transition in a weird way. Is years ago, I think I've told you about this. Years ago, I went and searched out all my sources of food in Northern California, went to visit each individual farm and everything to see what they do. Because like take eggs, for example, right? People say in the box it says free range chickens or cage free. And then you go to the place and there's like a 4x4 foot cage on a huge warehouse. And then so they get to see the outside, right? They get to see what it kind of looks like. So you have to like dig through this. And then the other ones will say, well, these are vegetarian feed. And just go, wait, are chickens vegetarian? No, they're not. They eat larvae and shit and bugs. And like, so you gotta do an enormous amount of research, right? And who has the time? But one of my favorite things that I always research a lot living in Northern California is like, this makes it a little bit easier, is we also have the best butter in the world, I would argue, with the Strauss family butter. And Strauss family butter, it comes from real close to the ocean in Sonoma. One of the best places to buy butter in the country. A lot of fine dining restaurants use it in California and throughout the country. Huge. Thomas Keller's a huge fan, but I love butter. Huge butter fan. And so what I was bringing up is like most people don't know. We never get to see the weekly polls. We don't know where they're posted. But I think the weekly poll was something to the effect of like who could house a loaf of banana bread faster, you or me.
Yeah. So before this show started, I normally, again, like Jason, I have to turn the comments off or I'll get too distracted. I did see one comment which said, this is the easiest poll in the world. I don't think this is the easiest poll in the world. I think if you know us, who is more likely to house an entire loaf of banana bread? That's a tough one, Jason. That's a tough one. First of all, like most basic white men, we love banana bread. This is true, by the way. I know that no women listen to this show. I promise you, if your boyfriend is white, he likes banana bread, and he thinks he's unique for it. This is our basic white boy.
Yeah, that was back in the day. My favorite thing was that stuff white people like. Oh God, those things were so good.
Banana bread.
So I will
likes banana bread.
I'll start then. I don't know why, but my mom's a shit cook. I'll just throw her under the bus right there. But she can bake her ass off. And one of her specialties growing up was banana bread. And she would let bananas, rot, or whenever the bananas rotted, she would make banana bread. and goddamn, could she make some banana bread. But more importantly, I just told the whole story about butter because I view bread, shellfish, everything is just a vehicle for butter. And so banana bread is an amazing vehicle with butter, like the way they balance and foil each other. So I slather like I obscene amount of butter. I mean, you think about like what's a lot of butter and like triple it, and you'll be like, God damn, that guy's got a problem. And then sprinkling in just that little bit of Maldon salt for like crunch texture on top. You mix in that salt, that butter, and then like that umami of banana bread. I will house a fucking loaf of banana bread.
Well, so this is why I'm going to say I don't think you could house a loaf of banana bread, because if you're throwing that much butter on halfway through the loaf, you're done. You're done. You're done. I don't believe
You'd
it.
be surprised.
I, on the other hand, just go straight in. My mother makes phenomenal banana bread. My mother-in-law makes exceptional banana bread, and she makes it for me frequently. She's just be like, I was thinking of you. Here's some banana bread. I'm like, this is why I love my mother-in-law for many reasons, but the banana bread, fantastic. Yeah, I will eat the whole thing. What people think I work out a lot. They think, oh, he must be so healthy. Anyone who really knows me knows the only reason I work out is because I eat like shit. Or if I was left to my own devices, I would eat like shit. I have to purposefully not buy food because I have no self-control. If there is banana bread in the house, it is gone within a day so that it doesn't get dragged out over a month.
Yeah, I was trying to think, and then okay, who would house it faster too is an even more interesting question, because for those that don't know, you're about twice my size. You work out much more than I do. Right, you're just bigger than me. So like, and who can eat faster? But then I was like, man, I felt like I always everybody thinks I eat fast too. I want to talk fast, as you know, but I probably eat fast too because I felt like I grew up in prison rules. Right, it was like public school combined with a family of close brothers and sisters, and my dad ate so fast. So like you ate with your arm around the plate, like prison style, and you just slopped it in as fast as you could because also you're on your way to like sports practice or whatever. So I don't know. I got speed too, but I mean, you are twice my size.
We'll see. This is a great comment. Next live stream, banana bread live stream. Screw rum, Pirates of Finance, banana bread. What if we did like spiced rum banana bread?
I was like, well,
you know, like rum cake. Like
well,
you could do like a rum banana bread for sure.
Well, what is it? Howler Monkey, which is Dana White's new whiskey, isn't it? Banana infused whiskey. I'm pretty sure that's what Howler Monkey is. I don't know, but
with a name like Howler Monkey, I would assume so. All right, let's hold on. I'm going to bring this back somewhat tangentially topical to what this show is about. I want to talk about SNIPD, SNIPD, which you introduced to Tyler, I think, and then Tyler was using it, and I was like, wow, I'm going to check this out. And now I think all three of us are just using it like crazy. So SNIPD is a podcast platform that allows you to listen to your regular podcasts, but also in the back end, they have a system. They say it's AI. I think Jason, you're skeptical that you think they're like actually sitting there snipping, but they claim to have an AI system that'll go through and figure out the most interesting sections. For podcasts that they have analyzed, they will create chapters, and then they will create snippable bits of the podcast. And if you're someone who wants to listen to a podcast but not waste 2 hours to figure out where the good content is, I have found it is amazing for just digging out the 5-10 minute gems within an episode. I mean, it has changed the way I listen to certain podcasts. It's brilliant.
Oh, I didn't realize you actually listen through it now, and like you're saying, you look at the titles of the actual AI snip segments, and then you just kind of skip through segments and chapters basically. Now you don't, because I just use it after I listen to snip for you. That's all I do.
No, I'll use it sometimes. Like if a new episode comes out in a show, and a lot of shows I don't listen to every episode. So if a new show comes out and it's been snipped, I will look at the titles of the sections and I will dive into certain sections, and then if I find that all the content is good, I'll listen to the whole thing. But I'm using it as sort of like a cheat to skip to different sections and figure out, do I think this whole podcast is worth my time?
Oh yeah, I was using it slightly differently. That's interesting. I may have started doing it that way and just using it as my primary player. But I was thinking about it. In general, I try to be a gentleman. Speaking of being a gentleman, going back to the banana bread, if you don't leave your butter on the counter, what are you doing, folks? Do not put your butter in the fridge. Like, especially with your banana bread, you can't put cold butter on the banana bread. So like a gentleman, I leave my butter on the counter, but also like a gentleman, what I would do is when I would send you YouTubes or podcasts, I would always put minutes like 18:35 to minutes 23:42. I'm very specific about that because there's nothing I hate more than somebody sends me a 3-hour podcast. Oh, listen to this. And you're like, what part? Like, give me some buy-in here.
Yeah.
What part and why? But I'm very detailed about that. So that's why Snip's great for me. I was like, now I can just send you like a 4-minute clip and be like, hey, listen to this part. But I mean,
it's brilliant. And I guess it's a bunch of, I was really pleasantly surprised. So not every podcast has gone through the snipped process. So not every podcast has these chapters. I was amazed. My podcast had a huge number of episodes that had already been snipped. Turns out the guys who started the platform are actually ex-finance. They all went to grad school for financial engineering. So they actually were listeners of Flirting with Models, which I was really flattered to hear. So I thought it was really cool.
We need
people should definitely check it out.
Hopefully, Tyler can snip like this part, and we'll send it to them because I also want like if somebody could do it for YouTube. I'm sure there's actually maybe something out there because that would be easier too. Like I would love to be able to use their YouTube as well. I mean, I can't. I think you're going to download her and then, but then as you know, we've edited YouTubes before. It's a pain in the dick to do that stuff. So is that you have a monster truck going by?
Listen, I wish I could show. So people who are watching might notice I'm in a very different location than I was in previous weeks. I've been kicked out of the room I was using. I am now in my basement, which in this nice pink room that I'm sitting in. And the door next to me is a garage door. So there was a truck that was just driving by. I apologize. All right. But this snipped thing I want to use as a bit of a transition to talk about. A few weeks ago, I was mentioning I do my Flirting with Models podcast seasonally. And I was contemplating trying to revitalize the podcast during the off season. And so I was going to snip certain sections of old episodes of evergreen content and upload them to YouTube and publish them as their own standalone weekly content. And so I started doing that. I've done 3 of them. And so far, and again, numbers are, it's hard to tell statistically whether it's a real jump, but I was already, my numbers in January, just 11, 12 days into the month, have more than doubled where I numbers in November, which is typical off season. Already north of where I am in December. YouTube numbers for the clips are way up. Number of new audience finding the clips and entering the podcast, way up. And so if this trend continues, I'm buying in. And let me tell you, discovering Snipped is making my life way easier because in the first one that I did, I had to listen to the whole episode and figure out what I wanted to snip. Now I just go to Snipped. I'm like, which section was good? All right, let me just clip that out. Let me clip another section out. It's making my life. This is like 20 minutes on a Sunday to get this done and reuse content.
I was waiting for 1, 2, skip a few, 99, 100. That within 18 months, you're the next Joe Rogan at this rate of compounding.
Listen, no one finds my content interesting enough for that.
So speaking of podcasts, this will give us a nice transition. Listen to podcasts on Infinite Loops on Jim O'Shaughnessy's podcast. He had his buddy Cliff Asness on this week, and it was a fascinating podcast for many reasons. Not technically why most of financial podcasts are more interviewed, but because they're friends, they did a more conversational style, almost like the Pirates. They did a podcast about nothing, and just had a chat between them, which was exciting.
It started off talking about crypto, which I wasn't expecting.
Yeah, they started talking about SBF and FTX. They talked about they joked about psychedelics, not really, but kind of had that popping in and out of there. But there was a couple of
Cliff all the supplements on his desk were. It's like 40 supplements there. I was like, how do you not ask him about what he's taking?
Well, I mean, you're too young to realize that. It's like as you get older, the bottles just start adding up, man. It's just like next thing you know, it's pathetic. But one of the things I wanted to bring up that was I thought right in your wheelhouse was overriding a model. And they were like, Jim always talks about he's always so proud he's never overridden a model. But then Cliff, they started getting into the nuance of that, though. There's a bit of a red, are you fooling yourself, though, if you have continuous research and you're adjusting models? What's the trade-offs between that Red Queen principle and saying you've never overridden a model? Or they even stated, like Cliff says, they have waiting periods of when they want to adjust to maybe new market data. They're like, are we fighting the last battle? Are we worried about what's happening on this year? and maybe you wait 6 months to see if you still would adjust that model. But like, how much do you think we're fooling ourselves if we say, I never overrode a model, but yet I have continuous research that affects my models?
You know, it's funny. I'm halfway through the episode, so I didn't get to hear that part yet. That is a conversation I'm looking forward to hearing, because I think that's spot on. Quants do this thing, and I'm guilty of it as well, where we say we're unemotional, we're research based, we don't make all the mistakes discretionary managers do. I have said time and time again, it's just a trade-off. We are in theory embedding our bias up front in the model, and then hoping to avoid ongoing biases by keeping the model consistent. But to your point, we never keep the model consistent.
No.
There is the expectation that we change the model. I think you have to change the model. And I've changed my mind about this over time. The world changes. Markets change. You need to be constantly trying to improve, make your process more robust. Why would you expect something that worked in 2005 to continue to work today? And the opportunities the market presents can be very different. One of the things I think a lot about is, like, Cliff is talking a lot about the value spread, and has been for a couple of years, and the opportunity of the value spread. So this is how cheap are value stocks relative to growth stocks. And he does all sorts of normalization to make sure it's a really robust estimate. It's industry normalized, so the same weights of industries. They're using multiple measures of valuation, and it's been sitting at extremes for a while. And one of the things I think about models like that is, when it's one standard deviation extreme, could be noise. When it's two standard deviations extreme, could be noise. When it's three standard deviations extreme, still could be noise. Like, there's just weird stuff that happens in data that could totally explain that. But when it gets to like 10 standard deviations, you start to have significantly less probability that it's just statistical noise that's driving this. And all of a sudden you might go, I might not, as a quant, have a system to take advantage of this, but to ignore it is to ignore a massive signal that, by the way, might come around twice in your investment lifetime. Right? And so you kind of have to take the discretion and say, am I going to blindly ignore this? Am I going to blindly ignore common sense that I'm trend following, and then the Fed injects how many billions of dollars into the market in March 2020? Maybe I should turn my trend following signals off, because this is not, like, my system is not programmed for this. This is uncharted territory. And by definition, like, none of what I've tested on is even relevant.
That's a great point, but it's always a delicate balance, though. Is this one of those environments or one of those events when that happens, and should you stick your hand in the wheel or not? And I think that's impossible to ever know.
Are you going to stick it in the right way?
That
you're probably going to get your hand cut off.
But so that's why, at the risk of stating the obvious, we get the question all the time, like, do you use or prefer, systematic or discretionary managers? And I'm like, there's not really a difference, because every systematic quant was a discretionary person that came up with the model, and then they're working in real time to update their research. And so it's man plus machine is the obvious answer to all of this, because, like you just said, it doesn't matter if I backtest 40 or 100 years of data. If the world dramatically changed and there's something outside of that data set, it's just garbage in, garbage out. And you need the art side of a person overarching that and saying, hey, this might not be the best move right here.
As a man of philosophy, I want to present you with a philosophical view of this. All right? Give me just one minute. If you go to a discretionary manager, they're going to tell you they have a process, right? That they follow, the types of things they look at. That process can be codified. So you codify the process and you say, is this your base process? And the manager says, yes, but here are some exceptions. Well, those exceptions, would that always be true? If that's always true, we can codify those exceptions. And you can continuously go through that process until you get to the point where the manager says, no, what's left is idiosyncratic decision making. And so my view is that a discretionary manager, by definition, is a systematic process plus the idiosyncratic decisions they make to override that process. And that's where their value is. And by the way, I think that's why it's so hard to figure out whether, like, statistically, the value out of a discretionary manager, because how much sample size do you need to really understand whether they're good at making those idiosyncratic decisions, right? But I think Like everyone says they're so different. No, discretionary and quants are exactly the same, in my opinion. It's just a question of, do you want someone making those idiosyncratic decisions? Wink, wink, nod, nod. To your point, quants are doing it too.
Right. Well, that's I could argue vice versa. What you said was perfect too. Is like when the quant needs to make an idiosyncratic decision, like Jim Simons has done before and pulled the plug, or if they change the laws around what the central bank's allowed to do, you maybe need to like pull the plug or change your system, even if it's full on systematic. But you also hit on one of my favorite points, and I love to poke fun at our value friends, in the sense that like I can't imagine being a value investor in that, I maybe get 10, 20, 30 at bats a year. Well, I would need how many decades of information to prove if I was lucky or good. And God bless them, I'll take luck every time. But I can't imagine living your life going like, yeah, I got maybe 200-300 at bats, and you're like, that's not enough sample size to know if you were right or wrong, or if you even outperform or underperform your benchmark. There's just no data there.
I don't think that's any really different than any intermediate term signal, truth be told. Right? Momentum, carry, value, intermediate term mean reversion, all of it. There's just the sample size is surprisingly low for a market environment that's constantly changing and adapting. Talking about podcasts, another podcast you sent me that I wanted to get your thoughts live on was Patrick O'Shaughnessy. So Jim's son, really two great podcasts from the O'Shaughnessy's this week. Jim's son had the founder of Gravity Blanket on his podcast this week, or maybe it was last week. I think it was
John Fio.
Yeah, John Fio. Incredibly strong opinions about B2C businesses. He had a really interesting view, in my opinion, particularly about raising capital for these types of businesses. So he has a fascinating story. I won't go into it. People should definitely listen to the podcast to hear it right from his mouth as to like what it was like to have $0 and try to launch these companies. But his view is basically, if you're launching a product like we want to launch rum, you should not have to raise money. You should be able to test the market, and the product should either be so compelling or it's exactly positioned correctly that there's such overwhelming demand from the market, you can get pre-orders that you can fulfill. If you have to raise capital to convince the market to buy your product, you're going to fail. And I thought it was this is a guy who's done this 3, 4, 5 times, right? Who is incredibly convinced. So much so that he's, he goes absolutely against the view that execution is everything. He says, no, good ideas are everything. Execution, like the execution is easy if you've got a good idea. And I thought, to me, I loved it only because it's so opposite of what everyone has been saying for the last several years about execution being everything. Just a very refreshing conversation. I want your thoughts as to how it's going to impact how we're going to bring rum to the market.
Well, I don't know about the rum side. And by the way, I still have a lot of questions for you from the Cliffy podcast, so we'll get back to that too. But you almost said like everything I was going to say about it. And because it wasn't like I had any really takeaways or anything. It was more about like the feelings of the things he talked about, right? Where you got to create that magic. And what he's saying is like a great idea is once it hits the marketplace and you prove product market fit, basically you get dragged into execution, right? He's like, when you have such a good idea and such a good product, even before you created it, you're going to be forced into executing. You lose your free will. And of course he's going to, like, if we got into the nuance, he'd be like, yeah, you need to execute well, no shit. But I think what he's hinting at is what I have to deal with all the time. I've been consulting with entrepreneurs for decades, and most people are entrepreneurs, right? They have all the excuses in the world why their business can't get off the ground. Right. And a lot of it usually revolves around like money or all the time, all these things. It's like, no, just go. If you have to, go around your neighborhood, start knocking on doors. Hey, do you want this? No. Well, you can find out pretty quick if the market likes it or not. But everybody likes to go in stealth mode, spend all this time so they can build up the precious idea. And then they deliver to the market to deaf ear, like to just, crickets. And so they just waste time. So it's actually a way of not wasting time. And I think that the counter example, like you're saying, over the last few years has been like the models for like MVP, minimum viable product, all of the, lean startup kind of ideas that come out of like more of the startup community, but applies to, like he's saying, to consumer goods more than anything else. And that's why he said he will never invest in consumer goods companies, even though that's his expertise, because like he said, you don't need money if it's done well. And he pointed out
that was fascinating.
Yeah. Even Facebook, he said, Teal didn't write that $500,000 check till they had like over 5 million users. So it's like, it was a really interesting thing where people, it was a way of flipping it around, and like you said, you become the ideas guy. And I think the quote was like, somebody said, well, no, ideas aren't everything. I have great ideas. And he goes, really? Tell me your best idea. And they're like, I'm not going to share it with you. Like, yeah, because you don't have any good ideas. And like people,
Yeah.
and so I think he's just pushing back too. Like, obviously you need execution, right? Execution is everything as well. But also part of execution is a great idea. Because I think on the podcast, you talk about positioning too. And so when I think about businesses or products or whatever, embedded in that product or business is the execution path, right? Like, is the pull forward of like the demand. Like, how do you structure this in a way where the execution is also going to be to part of the product, the marketing, the branding, and everything. And in most of the podcasts too, is like branding's got to have some magic to it. It's got to have some heat. You know, you got to cut through the noise somehow. And that's becoming more and more difficult to do in a, you know, flat social media world.
I have a off-topic question for you, but it just struck
Yep.
me. Are you going whaling after this? Your hat. I'm just like, I'm looking at your hat and your sweater. Yeah, your hat begs the question. Are you going whaling after this? Are you going hunting for jaws? Okay, no. Yes. So the positioning conversation he had was one for me that was like deeply uncomfortable.
Yeah.
Because back to things we were saying earlier, for me, it skirts this weird ethical line. I'm not sure it crossed the line, but he was talking about candles, and he was saying candles have such high margin. How can I get into the candle business if I want to make money? And he found this positioning of slapping astrological signs on candles and then calling them birthday candles so that they felt personalized. To me, to my detriment, perhaps, that feels manipulative to me if he's not someone who cares about astrology. I don't know why. It just feels deeply manipulative. But if the market wants it, the market wants it. Who am I to say it's right or wrong for him to deliver that good to the market? Maybe he's the perfect person because he's unemotional about it. But the market didn't want that product until he positioned it in a certain way to call them birthday candles, to say, this is a deeply personal gift that I can give you. It's just a candle. They are incredibly cheap and somehow incredibly expensive at the same time, right? Cheap to make, expensive to buy, and yet they're selling like hotcakes because of this personalized touch that he put on it. And it's not like he invented the candle. The good idea, the execution is easy. The good idea was just pure marketing.
Well, as you know, you hate when I always bring this up. It's like, we're all just entertaining each other. You know, that's all everything is, a narrative and story now, you know, and you know, even in our world, everybody's like, no, what we do is serious investing business. No, it's narrative and storytelling, and we're competing with Netflix, right? Do you like the cut of our jib more in investing with us than somebody else versus watching Netflix? And so, like you're saying, if you add enough gimmicks around that candle where people like, you know, really latch onto it, then that's where you create margin, right? Margin is storytelling. And this ties back into what we were talking about earlier with ESG, the Blackstone REIT, like all of these things are narrative and storytelling. That's my question now, is like, it's not about money. It's not about, you know, cost to project COGS or any of that stuff. It's all about narrative, storytelling, entertaining. Can you be entertaining? Can you cut through the noise? Can people express their views, opinions, morals, ethics, and their form of entertainment through you and the consumer purchases? Kind of insane to think about, but it's also like, just like kind of accepting the state of play. And that's, I mean, this is the way I kind of look at it. And there's other great ones too. Like I was also related to that when I was listening to the Due Diligence podcast with Dulma, and she does like a lot of like CPG and kind of like direct to consumer products. And the guy, I'm gonna forget his name, was on the podcast. That's killing me. But basically, he was saying like he doesn't even invest in food like direct to consumer food products, because like the margins just get squeezed over time and you're going for scale. Where if like it's a beauty product, like you're saying, you could tell a story and you can put a price on that jar, that tiny 1 ounce jar of $40, $80, $200 for eye cream that you can't do in like a commodity like food. So it's even interesting how we position there, right? Like what kind of stories are you willing to tell, and over time, what kind of scale do you need to require?
Absolutely. I'm noticing, looking at the time here. You want to bring Tyler in?
Yeah. And I got some questions for both of you then with the Cliffy pod.
Yeah, let's return to the Cliff. I apologize for taking
Tyler
us
might
off
not be
that
able
so
to.
quickly.
He might not be able to come in. Yeah. Let me look at the.
All right, he's tied up.
Okay,
he's
perfect.
tied up.
All right, so
All right,
I'll go back to two quick hitters, and then the one I really wanted to pick your brain on. One, they talked about a little bit inside baseball for us, but I thought this was perfect to highlight in general and publicly. is they talk about, you know, when media like quotes you and writes articles about you, and then the headline is like disastrous, and they're talking about like the actual article and the quotes. One, a lot of times the quotes are misattributed or taken out of context, but more importantly, people have no idea how many times headlines are done by somebody else, not the actual writer of the article, and how those headlines are split tested and
Yes.
A/B tested and iterated, and it's all about getting eyeballs on that headline, and the headline might have nothing to do with the article, and it's quite be the opposite sometimes. And I just think of that Gelman and amnesia of like people don't realize what's going on behind the scenes for articles that they think they're reading that are trying to be objective.
What a dramatic change in the internet era, right?
Right.
The To have someone else write the title, I think is a holdover from the print era. But to be able to A/B test it and change the title throughout the day to figure out what's getting traction, to then settle on a final title that gets you maximum traction, is it goes back to this question of like, is optimizing for eyeballs the right thing? What are we doing to ourselves optimizing for eyeballs, right? And conveying information. Are we stoking outrage? Are we making sure we're telling truth, or are we telling some version of the truth that we can sleep with that maximizes eyeballs? It feels a little dirty, right? But you get quoted. You might say a whole bunch of stuff. They use one quote from you that might be out of context, and you don't get to then correct the context. And then some headline is given to it by someone else whose job is to maximize eyeballs that gets A/B tested all day. It's scary, frankly, to work with the media. I did love the comment though from Cliff, and Jim said this a bit too, is like they just don't see any benefit to going on like television anymore.
No,
And,
that was
they actually talked up podcasts quite a bit, which I loved.
Yeah, they actually All In was talking about the same thing. It's like, why go on media if I can just put myself out here in long form for an hour and somebody else might butcher it up? Why even bother? And to your point, is like they even talked about going on financial television media, and that what people don't realize too is like the soundbite era, right? And like they have to beg before they come on. Give me 1 minute to talk, and they're like talking about that doesn't even have 1 minute an eternity to talk because everything's about sound bites. But even worse that people don't realize is a lot of time you have the thing in your ear, the bug in your ear, where like after 10 seconds, they're telling you to wrap up your topic. Do you know how hard it is to think and talk while you have a producer talking in your ear? Like it is a special skill that these people can do, because like it's not like, so you fumble or whatever on national television. Like it's understandable because of all the things going on.
Yeah, I've done live television twice. I've been invited a number of times, fortunately. Oh, maybe I've done it 3 times. It's petrifying. I've done live television in studio, and then I've done live television remotely. And you get brought in, and you have no idea what questions are going to get asked most of the time. You have some semblance of a topic. They don't really tell you how long you have to talk. You just know you're not supposed to talk that long. And like they will cut you off. They won't let, and they'll ask questions that probably deserve a 10-minute discussion that you're somehow supposed to wrap up in 15 seconds. It's wild.
The other quick hitter from Cliff was I mean, I respect it. It's just not for me. But if you were Cliff and Cliff's stature or whatever you want to call it, would you be Twitter beefing with anonymous trolls on Twitter like the way he does?
That's what makes Cliff, though.
I know.
Right? This goes back to like the intrinsic DNA of a human. Like that's what makes Cliff. To his credit, Cliff, I have found him to be, as much as he's argumentative, Cliff is incredibly gracious, and he will, if you are truly well-intentioned and you don't understand something and you ask him to explain it, he doesn't care who you are. You could be anonymous, you could have $2 or 2 cents to your name. He will take the time to explain it to you. I have found him incredibly approachable. I find him incredibly generous with his time. He has been a huge cheerleader for me, which I deeply appreciate. Yeah, I just, Cliff is Cliff, and you want it. So the cons are that he's going to argue with an anonymous troll online. You know what the pros are? He's going to have a conversation with an anonymous person online who, has a genuine question, and he's going to respond. And I think that's admirable. He doesn't have to.
Then they talk about it on the podcast too, and that's like, it's to your point. It's like for all the bad that comes along with it, some good, where somebody genuinely wanted to learn something and they maybe didn't have the popularity of somebody else. And so he's happy to entertain that just in case, or the probabilities of that. But the one I wanted to really get to with you that always kind of bothers me, or something I constantly think about, and it was really serendipitous to hear it on their podcast, because I was thinking about it a few days ago, in the sense that, everybody goes, everybody loves Warren Buffett. And then they go, Warren Buffett says you should index, therefore you should index. And my question is always like, what does Warren Buffett do? Does he index? No. So do you listen? What kind of advice do you listen to? You listen to what people say, not what they do. But what it was interesting. So I was thinking about that. And then on the pod, Cliff and Jim start talking about how they both recommend indexing. But then I think Jim was the first one to bring it up. It's like, is that contradictory? And they both think it's not, even though, so they both do not index. They both do very, other various quant, different systems and different strategies they run. But it's an interesting conundrum to me. I think it's contradictory to recommend indexing if that's not what you do. It's do as I say, not as I do. But I can understand the other side of the argument.
This is a really tough one for me.
Yeah.
I certainly don't index.
Right.
I certainly do. I use a bunch of leverage. I run, strategic stock and bond allocations that I overlay with managed futures. I'm comfortable with it. Would I ever recommend to my average friend who could not tell me what stocks are to do the same thing? If there was if I felt that there was an off-the-shelf way for them to do it in a very easy way, and I felt that they could behaviorally stick with it, and I knew that it met their financial plan, maybe, but I'm not their fiduciary, so it's a really gray area. Like, they need to talk to their advisor. Yeah, this is a tough one. Like, the reality is, I am of the opinion markets are generally efficient, and that the market diversified stock and bond portfolio is a tremendous wealth generating vehicle over the long run. It helps complement your human capital to be able to diversify basically into the GDP of the world, GDP growth of the world. Like, people should do that. And the default hypothesis for me is like the market's in an equilibrium state. And yes, probably passive is a good starting point. Do I think most people have the capacity to go beyond that? I don't, actually.
Great. Thank you for saying that. So many things in there. One, if the default is indexing, that means you're giving advice. And so why are you giving advice? Why do you say anything at all? Why just say, I don't know, I can't help you? Because you're telling somebody to do something. You're giving them advice when you shouldn't be, it would be my argument. And then the second thing is, it's like, I wonder too, if it's very pedantic, right? You're saying, look, I think you're a moron. I'm not going to sit here for 5 to 10 hours because I don't care about you enough to even start to explain things, let alone the 100 or 1,000 hours it would take. So in essence, you're basically saying, hey, I think you're an idiot, so I think therefore you should index. But also you're choosing a path with indexing too. That, like, is that the right path for that person? I'm not so certain. So you were bringing up a philosophical conundrum. I thought you were going to bring up like the trolley problem or something. And you know how I am. It's like, I always wonder that trolley problem, they give you an A or B question. When isn't there an option C? Like, why do you have to do anything? Can't you just stand there and watch everything go down?
Or can you stop the trolley? I don't know. Why can't anyone?
No, like, why do you have to make a choice at all? Like,
right. Is a lack of choice, is choosing the default, right? I think in finance, we would argue passive is the default choice. Is the default choice a choice, or is going off the default really the active choice? That's a tough one. I agree with you that there are many choices that can be made, and the more people who go active, it actually changes the composition of passive by definition. It's a push and pull system. Passive is just, you're basically getting a free ride on the work of active managers, and you hope there's sufficient active managers to do the work to make passive efficient. You want all those active managers competing with each other so that passive can get a good free ride. Passive can go wrong. I mean, active managers got it, in my opinion, in hindsight, really wrong in 2000 with the tech bubble. And passive rode it all the way up and all the way down.
As you know, there's an ergodicity problem though too. And you're saying over the long haul, then you should be passive indexing. But why wouldn't the choice be just hold cash? Like, you're saying, you're telling them to hold in cash, they should be investing. And you know as well as I do, there's lost decades of being underwater.
You're doing a little loopy-doop on me. If we're talking, let's set a base case here. If they're saying, I want to invest in stocks, if they've already made that step, right? Am I going to say, oh, you should be a value investor? Oh, you should be a momentum investor? Oh, you should do a multi-factor defensive style portfolio? Or am I just going to say, do you want to just buy the S&P? Right? Buy the Russell 2000 and the Russell 1000. Buy the Russell 3000 if you can, right? Cheap, low cost ETF. Keep allocating, keep working on your human capital, because probably that's where you're going to make most of your money. Like, if they're not truly interested in this stuff, I don't know. I'm not sure if they're qualified to make the decision. They should be outsourcing that to someone who is going to understand and care.
That would be my point. It's like, I think even in the comments, our homie Dave said, by the way, nice to see you in the comments, Dave. It seems unreasonable to expect all of those people to become active investors participating in price discovery. And I'm not, that wasn't, I hope it was clear. That's not my expectation. My expectation is like, why do people think they can do this passively? And then the recommendations are for them to passively index. It reminds me of the crass old joke by Andrew Dice Clay. I don't come down to your job and kick the dick out of your mouth. Like, I don't like, it's weird. It's just weird. I don't go to surgeons and say, hey, I don't go to surgeons and say, give me the 5 minutes here. I gotta sew up my girlfriend. Can you just give me a quick 5-minute tutorial? How do I passively sew her up?
Right. Well, okay. But why are you expecting, like, if my friend comes to me and says, hey, I'm trying to put some money to work and I want a 5-minute primer on how to invest? Like, why is it not okay to say, you want to know what? Go find the default target date fund that's going to get you good passive exposure over time. It's good enough for what you need. No, first of all, I shouldn't be giving that advice anyway, because I'm not, again, I'm not their advisor.
This is a financial advice. Yeah.
Go engage a financial advisor, right? But I personally don't have an issue with passive. I think passive is phenomenal for a huge swath of people.
I don't say
it meets their needs. Great.
Yeah. I'm not saying I have an issue. I think it's just an interesting contradictory advice issue coming from active managers to tell people to invest passively. And also if your friend that comes to you, I say, okay, why don't you go read these 10 books, come back and let's have a discussion. And then you read these 10 more, like that shows you care about them.
But by the way,
they're not going to do it.
But it's not contradictory for active. Let me explain why.
Okay.
If you do it like Cliff does it 2 ways. He does alpha beta separation, which is you buy the passive market, and then you do a bunch of market neutral long short portfolios, right? So he might go long value stocks, short growth stocks, and try to capture the premium there. But if you want the beta by definition is passive. So you buy the beta, and then the alpha is this market neutral concept. Now, for a lot of people who aren't comfortable going short, what they do is they buy the beta and then they adjust the weights. They buy more of the stuff they want and less of the stuff they don't want. But that decision itself can still be separated into, you bought the beta and you are implicitly long, extra long, the things you want, and you are implicitly short the things you don't. You can create an alpha beta separation there. So there's no getting away from the fact that every active manager is providing the beta. It's just a question of how much active risk are they taking in that long short that they've put on top. That's their job. It's the long short. But the beta is always there. And so I'm not sure it's in contradiction to say, you want to know what? Like, yeah, I think that alpha part can add value over time over the long run, but the beta is still the primary driver of returns for almost every active manager. So why not just say to someone, just buy the beta if you're not going to take the time to learn about the alpha?
I'm not necessarily even disagreeing with that. I'm saying, like, we don't even realize, like, where did we get to step one? I mean, usually because of my general dickishness, when somebody asks me these questions, I go, what do you do for a living? And I go, okay, how do you make money doing that? Or how do you save more? Why are you even talking about investing? Because usually they're talking about investing as a separate way to get rich. And I'm like, you don't get rich off your investments. You save more, you outpace inflation, and your retirement will hopefully be there when you need it. Like, that's the discussion we need to have, not go out and buy V-Banks or whatever the generally accepted advice is. But before I bear trap us into more compliance nightmares with this conversation,
you're really doing a great job here.
Just shooting ourselves in the foot.
Yeah. Are we wrapping? Is that what you said? You want to wrap?
Yeah, let's wrap it up.
Yeah, before compliance begs the question as to why we were talking about any of this. Ladies and gentlemen, that's going to be it for us before we get into any more trouble. We appreciate you taking the time to tune in, whether it's live, Big shout out to the Booty Crew. Comment section looks like it was on fire today.
It was on fire today.
I hope those of you who were here live on Friday, we appreciate your time. Those of you who are tuning in later, we greatly appreciate your time. Again, if you guys could give us a like, subscribe, review, leave a comment, fuels the algos. It helps other people find us. We greatly appreciate it. With that, Jason, I guess we're out. I'll see you next week.